and welcome to this Diwali special on ET Now. I am Anisha Jain. Well, joining me today on our special series of Wizards of Wealth is of course Mr. Anup Maheshwari of 361 Asset to talk to us about his wealth mantras and what does he feel about the market in the coming 1 year or so. Hi Anup, thanks so much for making time and speaking with us.
Thanks for having me, Anisha.
You know what, I tell a lot of my family and friends that I get to meet them only once a year on Diwali. It's even worse for you. It's been much longer that you've made time for us. What's keeping you so busy?
No, my apologies for that, but we've been busy building up the business, trying to build up our asset management company. And it's been exciting. I mean, India has been a great place to be, so we've been doing that, talking to a lot of global institutions and clients. So it's been nice. It's been good.
Back home in India, this earnings season hasn't really kick-started the way we have seen for the last couple of years, and the recency bias is that the market can only go up. With that construct in mind, do you see that the next 12 to 18 months are going to be tougher in the sense that we're looking and staring at only a high single-digit kind of return at the index level?
Coming to India, yeah, I mean, at the end of the day, markets are slaves to earnings. And we've had a fairly good earnings outcome post-COVID, and that's partly also reflected in the way markets have moved. Of course, valuations have expanded even higher than the underlying earnings growth. But going forward, I think from the current valuations that we are at, earnings become very important. And we are in a phase where we're back to that 10 to 15% type of earnings growth range. So you have to therefore moderate your expectations from equities accordingly. To that extent, yes, over the next year, we wouldn't be surprised if we are in a sort of low or up to single digit sort of return profile. And that's a good thing, actually, because in the longer run, you don't want excessive returns every year because that will just set you up for a bigger correction at some point. I think a good consolidation, a year where it just consolidates and you don't really focus on returns as much is actually good in the longer term if somebody is looking at investing over a period of time.
Yeah, that way consolidation is good, but you don't see a risk of a meaningful correction in the market right now, or do you see that as a potential threat?
So, again, Isha, when we look at past corrections, we have done this analysis of, Warren Buffett's first rule of investing is don't lose huge amounts of money, and rule number 2 is never forget rule number 1. So we said, let's define what do you mean by losing huge amounts of money. So we looked at, we defined it as a 30% or more fall in the market.
30% off?
30% fall in the market. Now, if you go back over the last 40 years in India, we've had a 30% fall 7 times. 7 times the market has fallen by 30% or more from the peak. The last time was during COVID. When we looked at each of those falls, we looked at what the valuations were before the fall. And typically, in each of those cases, the price to book ratio had gone beyond a certain threshold, which gave us a warning that markets have to digest that. Now, when we look at today's case, and when we look also at the previous falls, typically those previous falls were associated with either a big macro problem. So if you go back to 2013, India was a fragile 5 economy. Lots of macros were not in good shape. So it's either a macro problem or a financial services sector problem. Typically, that's where we get those big falls. And when we look at it today, we don't see either of these challenges. So the macro is as strong as it could be. The financial services sector is relatively clean. So to that extent, expecting a very big fall on local factors seems unlikely. You could always have something coming left to center that hits you globally. But our base case is that it would be probably a time correction or a shallow correction, but not a significant correction.
Okay, so a shallow time correction is what you're anticipating, but within, let's say, large cap, mid cap, small cap, is there a bias that you have?
Yeah, I think at this point, large caps definitely look better. Just circling back to that valuation point I made, just to give you a sense on how price to book works in our market. If you look through time, a very long period of time, let's say the last 25 years, 85% of the time, the market has traded between 2 to 4 times price to book.
Okay. Right now we are at?
We're at actually 4.
So we are at the higher end.
We're at the higher end, which is why I'm saying markets need to digest that. But 85% of the time we're between 2 to 4. 10% of the time we've been above 4 times price to book. and 5% of the time we've been below 2 times price to book. Right? That's the range. Now, within that range, your returns differ a lot depending on where you are. If you look at the 5 years after, so if you bought the market at 2 times price to book, your next 5 year returns historically have been 40% CAGR. When you buy the market above 4 times price to book, the next 5 year CAGR has been 5%.
Yeah,
right? So you've got to adjust to that factor when you look at things. So therefore, when we look at markets today at 4 times price to book, our view is that you need a consolidation. Book value itself grows by 10 to 12% every year. So just by staying at the same place, the market will get cheaper, which is what a time correction should do for us. And then you're better set for performance after that. So that's the way we sort of broadly look at these ranges and take our market calls.
Interesting. But coming back to that question on the large cap, mid cap, and small cap
So
buyers.
sorry, that was the lead to that. So what we're seeing is within those segments, what we observed is when you're at the lower end of price to book,
which is around 2 times.
At around 2 times, that's the time to take the highest risk. Oddly enough, so this is counterintuitive.
Yeah.
When markets are down, people want to be safer, and they buy large caps, defensives, etc. But actually, that's the time to buy deep mid caps and take the highest amount of risk.
Interesting.
And the reverse logic works on the way up. At 4 times price to book, people are willing to take a lot of risk, look at small caps, mid caps, whereas what you should actually be doing is being more in large caps. So right now we are suggesting large caps is a better place to be, just given the way mid caps, small caps have done, the relative valuations of them, and the fact that overall earnings are moderating across the board. So therefore, large caps offer you a better risk reward compared to small and mid caps.
Okay, so that clearly puts it in perspective with a sound logic there. But if I had to ask you, let's say talk sector specific now, and talk to me the areas where you still see that either the valuation comfort is there, or you're paying valuation for the kind of growth that they're offering. Any sectors that you want to call an overweight on?
Sure. So again, here the broad template one would use is you would prefer sectors with some element of pricing power.
Okay.
If they have pricing power, that pricing goes straight to your bottom line and creates excess profit growth. Now, which are the sectors that have pricing power today? Telecom has pricing power. We've already
finally, after 5 years, a hike.
We've seen a price hike. Maybe it needs to be digested. The next price hike will take some time, but prices are logically going up, not down. Another interesting sector that we think would be where there's been a lot of consolidation is cement. I think we've probably seen the worst of cement with this quarter. Going into next year, we'd expect after all this consolidation, some price hikes to start taking place. So cement would be the other sector that I think would look interesting. And beyond that, I'd say there's some very specific opportunities. So for instance, in the pharmaceutical space, within that, contract manufacturing seems like a very interesting area. A lot like specialty chemicals was 4 or 5 years ago, where there's a lot of capex happening there with the Biosecure Act in the US. There is more business visibility for Indian companies to scale. So the whole CDMO space, I think, looks fairly promising as far as we're concerned. So these are some spots that look reasonably good. Financial services has been a bit of a drag sector, but valuations are reasonable. At the end of the day, India, 1/3 of the market is financial services, so you can't ignore it. Valuations are sensible, so financial services would be the other area.
So basically, you're talking about the sectors which haven't really done well. Cement has done nothing for many years now, even in terms of pricing per per bag, it hasn't really changed that much. Telecom, of course, was a laggard. There have been so many movements there, so can't really call that one out. Pharma, and the last one that you said was financial services. Now, within financial services, because it's such a large sector, there was last couple of years there was that big re-rating of sorts of the PSU banks. Do you think now they are ideally reasonably priced, or do you still see that Street hasn't really appreciated the value there or the turnaround possibility?
Yeah, banks overall, I would say both PSU and private are reasonably priced. Private more so.
Okay.
So our preference would be private sector banks, but some of the largest PSU banks are also interesting from our point of view. They're almost private sector like. So I would say that within financial services, that is a good spot. We've seen, of course, capital markets do incredibly well. Stocks there. I think there as market takes a breather, we may need to see a bit of a breather there, but that's also a good
Healthy,
sector to look
yeah.
at eventually. And then you've got insurance, which I think is good. You have NBFCs. NBFCs, I think, have people have been hoping for a lower interest rate environment to get a little more positive NBFCs, but NBFCs are also facing higher regulation now. So I think there's a bit of a give and a take there. So we prefer banks,
Over
parts of
NBFC.
capital markets, and insurance.
Okay, fair enough. Let's talk about some larger, bigger mega trends that we have been watching out for, and everybody's talking about, right from energy transition, EVs to the manufacturing hub that India is becoming for exports as well, or whether it's about Genia, etc. What's the best way to play all of that in the Indian markets, and which of this or anything else would you call the mega trend that you are watching out for?
So clearly, energy is a big focus area, and energy in terms of either green, all sorts of green
Generation,
hydrogen,
yeah.
etc., or renewables, and at the same time, even thermal capacity seems to be growing to some extent. So I didn't mention it, but even the power sector is an interesting place to be, just given the scale of investments going on there and the potential of growth.
But which are the areas which you would recommend people to stay away from in the equity markets right now?
We've been fairly underweight on staples.
Okay.
Yeah, the one part of the economy that's bothering us, actually, if you had to ask me, is the whole consumption side. Some of the other areas where valuations are high, but there's also growth. Capital goods, for instance, I think valuations are high, but then you've got some really interesting potential outcomes there as well. So you have to be picky and choosy. You can't just label the whole sector as avoid.
Almost feels like you're preparing us that it is going to be a bit of a year of consolidation. So be prepared for that. You might get bored of the market not going anywhere. It might be a bit sideways, but hold that patience and hold that belief in the Indian market. That's the verdict coming in. Thanks, Anup, for making time and speaking with us. Really a pleasure.
Thank you very much, and wish all the viewers a very happy Diwali and a very prosperous New Year, and for your families as well. Thank you.
Okay, with that, it's a wrap on this conversation. Stay tuned to 18 hours for more. What is your definition of wealth at a personal level?
Wealth is more in the form of relationships.
What's the best tactical trade in the very immediate short
A lot of people are looking at commodities actually.
What the portfolio allocation should be like right now?
Typically, you'd want to have at least more than half of your asset allocation towards equities, anywhere between 60-70%, depending on your risk appetite. Uh, Fixed income again is a function more of your ability to handle volatility and downside. So that could be 20%, 30%, and the balance would be really these type of tactical opportunities, commodities.
What would be your best investment decision, would you say?
One good decision has been coming to this firm because we all have ownership, and that's become a good stock decision as well.
Any FOMO?
A decade ago or 15 years ago, we used to say HDFC. We had missed out HDFC in a big way.
Or the rule book that you've created for yourself when making investment or guiding on investment?
So I think the key is to remain true to your own style.
Give one wealth mantra for the next 1 year.
Keep the faith is what I would say.